we're going to be taking a look at the three different types of structure at this point, right? So we can all agree that this is a bullish structure, right? Why? Because this is a sequence of higher highs and higher lows. So we're generally pushing up, and this is a bullish structure. Now the bearish structure is the same thing, just flip the other way around, where you have a sequence of lower highs followed by lower lows, right? And this is your bearish structure. Then you lastly have your consolidation market, where the market maker is essentially accumulating positions left, right, and center. Now, if those are buy or sell positions, we don't really know, and we will actually never know with 100% guarantee, but those are the three different types of market structure you will get. However, when you start looking at the candles, you will see that the reality is much different, right? You will never have a perfect bullish structure where prices just retracing perfectly and continuing up, right? Because otherwise everyone would just be waiting here and catching the buys up, and it would just be too easy to make money. And that's not what happens. You will never see a bullish market structure that looks perfectly bullish like this, because it would be too easy to make money. And if we look at the statistics, we all know that 95% of the people trading consistently lose. So that's not the reality. Matter of fact, we're going to get into the reality of a bullish structure. So let me go ahead and draw it. Potentially something like this, right? Okay, this is actually a valid bullish structure, right? And within structure, you need to differentiate between two different types. And this is pretty important, guys. So actually go ahead and take notes. We've got external and internal structure, right? Now, when we talk about external structure, let me actually go ahead and use, for example, red. So this right here would be your external structure. None of this nonsense in the middle where prices going up and down. The major swings that make the skeleton of the structure, right? Because you really need to think about structure like a human body, right? Your external structure would be the skeleton of your body. So if you connect the dots, using this tool, for example, we can see that we have a perfectly bullish trend. However, price is just not making a perfectly bullish structure, right? Price is having short-term bearish breaks, right? That then resume bullish and continue the overall trend, which is bullish. So now that you understand a little bit about external structure, we'll get to into that later. Let's take a look at internal structure, right? What would be your internal structure? Well, your internal structure would essentially be anything besides the external, right? Which is essentially all these points right here. All these points right here will be considered your internal structure or internal trend. It's essentially the same thing, right? And as you can see, we can very well have a bullish structure, but a short-term bearish internal structure. So that's where the confusion begins. Let me actually take a different color and label the internal points, right? This would be your internal structure right here. Let me finish doing that, right? So as you can see, price can very well inside a bullish trend, right? Don't forget we're overall in a bullish trend, but can short-term shift bearish multiple times to then just resume bullish, and you maybe try to sell some points over here, some internal lock marks over there, and then get caught and lose money. Well, that's the reason being is because you're not paying attention to the overall picture, which is we have a bullish trend, right? I'm not saying you cannot make money selling in a bullish trend, but this just like trying to drive on a highway on the wrong direction, if I'm being honest. So let me go ahead and remove some of this stuff in here, not everything, so we can get rid of this. And let's continue talking about structure. So your external structure is pretty important, right? Because this is what's going to determine your higher time frame trend, right? So if we get it, this external structure means higher time frame trend, and your internal structure is your lower time frames trend. So now that you understand that, and if you actually know how to translate all this into candles, then you would understand that the higher time frame in a specific market structure that looks like this would be bullish. So you would be essentially looking for buys most of the times, right? Now, if you know how to trade ranges, and that's a topic for a different video, then you can potentially get into sells. For example, if you have, so this is your structure as we were discussing, and all of a sudden price starts coming down, right? And right in here you say to yourself, okay, we're just broken structure here, bearish, so I may want to take the risk because I know that with probability we can maybe get somewhere down in here because we need to retrace at this point since we just made a new high. So we may want to retrace, and I want to play that retracement. But you need to understand that you're playing that retracement, right? And nothing else. And you shouldn't be expecting somehow new lows and all that kind of stuff, yeah? So what I'm trying to say is that as long as you keep your high time frame trend and your high time frame ranges in mind, it's absolutely fine to maybe take a counter trend trade here and look for your sell down. That would mean your high time frame retracement to then continue pushing up, right? If there is going to be enough demand sitting below here, then the bullish trend is going to resume. Otherwise, you may get a, let me remove this, you may get a retest of the high, right? Maybe some supply in here, and then price will decide if it wants to shift bearish or if it wants to continue the bullish trend. In case you then come back to the highs, you get a test and price melts down and breaks the previous low, then your external structure would have shifted bearish, and then you can continue selling, right? Waiting for the retracement to then continue selling, because now you would have 1, 2, 3, and 4, and connecting all these dots, that would mean a shift in market structure, right? Let me get a different color, green, and that would mean that you are now in a bearish environment, and now you can take longer term sells and play the internal structure for buys. So yeah, that's what I want you to keep in mind in regards to external and internal structure. Your external structure is going to be your swing trades potentially, right? Because you're going with the overall trend, and your internal structure could be used for day trades or scalps, because now you know that you're playing the internal structure and that you have a range to fill and that you can potentially get somewhere over here. So that's that in regards to structure, and now we're going to move on back on the charts to continue explaining further stuff and showing some examples. Okay, traders, we're back. We're now looking at Euro USD on the 4-hour time frame, and what we're going to be doing is translating everything I explained you before into the candles and the charts. Okay, so if we look at the external structure of this chart, I think we can all agree that this is an important external structure. This right here is, and this right here is, right? If you connect the dots, you have a structure that looks something like this, right? And if we actually pay close attention, and I know this is difficult to see, but just bear with me for a second. If you zoom into the price action, you can see that this previous structure, right, this previous external structure got taken out by this wick right here, right? It barely reached above, but it actually did take it out. So now you have a potential shift in market structure because now we made a new high above the previous external structure. Whenever you have a break in market structure with a tiny wick that barely reaches above it, that means we have a wick break BOS, right? You have a wick BOS. And what does that mean? Well, that means that price didn't have enough liquidity to continue pushing up. And for that reason is why you're seeing the entire impulsive move up being corrected right here, right? So every time you break structure with a tiny wick just reaching above or below it, that means that price needs more liquidity, and with probability is going to retrace the entire move to then gather more liquidity in the form of orders and stop losses, and then potentially resuming and continuing up, right? And if we actually look at the structure, a potential bias you could have on EU would be something like this, right? You could say to yourself, okay, we had this bearish pressure that just got taken out with this wick break-in market structure, which now I know that means that price needs to retrace all the way down to grab more liquidity to then potentially continue up, right? And this is actually something I'm waiting for, right? I'm waiting for any POI inside this region to continue potentially going higher. So now that you understand that, let me zoom into the lower time frames, maybe the 1 hour. And as you can see today, I was expecting buys from this region, but that's a topic for another day. So if we zoom into the lower time frames, we can see more external structure, right? You got one here, one here, one here. And if we just connect the dots, you would see that we could potentially be expecting bearish pressure. And that's why I was waiting for buys for somewhere in this region for a retracement. I know I'm playing the retracement. I know I'm in a range. And I know I can maybe get some pips inside of this range, right? I can expect something like this where I can have a move up from this region all the way into a POI somewhere in here to then continue dropping into the higher time frame external structure that is going to provide me maybe the huge move up, right? Another possibility is price coming all the way up here and then melting down to then resume in the higher time frame trend. Lastly, guys, I don't want you to get confused, wondering and asking yourselves, well, what time frame should I use for the external, which one for the internal, right? That's not the point of the video. What I wanted to explain to you is the difference between the external and internal structure, right? You can potentially be using this 1 hour in external time structure to play the 5-minute internal structure, right? Just putting everything together. If you know that within your 1 hour time frame you're hitting this external point, then well, maybe I can get a retracement all the way up. Potentially watching the 5-minute, I can get my confirmations and all that sort of stuff. So yeah, that's that. I don't want you to get confused wondering what time frame is the best for the external, which one for the internal. That's not really the point of this video, right? You could very well be using the 1 hour external structure to potentially play a 5-minute or a 15-minute internal trend. It's about putting the story and everything together, right? Structure alone will not tell you when to buy and when to sell. It's just to guide you and so that you understand where you are in your range. That's pretty important. And where you are potentially heading. Let's simply draw a consolidating market, right? We can all agree the market is consolidating at this point. And if you trade retail concepts, right, what you've been told is that you need to buy at support, sell at resistance, and retail traders are looking at this, oh, we bounced, bounced, bounce, bounce, and bounce. So the next time the market comes on here, I'm gonna sell. And the same thing for the support buyers, right? They're gonna be looking to buy down here. Now, what the market has actually done when it's doing something like this, it's engineering liquidity. It's creating liquidity in order to potentially move in a intended direction, right? So liquidity is essentially when there's multiple stop losses around a similar or similar price point. Now, I'm not talking about your $100 retail stop loss, right? You need to understand that the Forex market, the retail traders make up only 5% of the total volume traded in the Forex market. We also have smaller banks, small institutions, which are also trading. So to illustrate that further, we can safely say that we have liquidity up here. Why? Because people are looking to sell right around here, and we're going to put the stop loss. The stop loss is going to be, we're gonna have multiple stop losses all around this area, right? Just imagine those circles are actually stop losses, right? We're gonna have stop losses all around here and stop losses all around here. So what you will find is most of the time, if price is actually going to break out and move up, first what it's going to do, it's going to move down potentially into a area of inefficiency, into a POI or point of interest, right? It's gonna move down. It's gonna, while it's moving down, it's grabbing all that liquidity from the retail, and then it's gonna shift, and you're gonna have the up move, which is going to target all the liquidity sitting above here, right? So now that was the explanation of what liquidity is. What you need to understand is liquidity is the reason why the price actually moves. And the algorithm is going to target those liquidity pools or liquidity areas, just as explained in this example. We've got the visible liquidity and the hidden liquidity, and we're going to start with visible liquidity because it's much simpler. We only have one type, and we're going to be discussing that right now. So the only type of visible liquidity you have in the market is the relative equal high and low liquidity. And to illustrate that point, let's draw a potential downtrend, right? And let's go back in time and think about when you first started trading and you were introduced to all these concepts: support, resistance, double tops, double bottom, triple top, triple bottom. And yeah, essentially, relative equal high and low liquidity is that double tops, triple tops, double bottom, triple bottom, right? Let's imagine price starts to push up and it stops here, right? And it starts to bounce. As price starts to bounce, what we know is that there's going to be multiple people that are going to be selling this. Why? Because they've learned this is a double top. We need to sell right now. Price is going to fall. And what you will find if you actually look at the charts, it's you will have a mini reaction, right, which is known as inducement. And most often than not, then you will get price to actually blow through that double top and then melt. And they're going to be left wondering why, what happened here, why did I lose, what did I do wrong, this and that. Well, what they didn't know is that they were selling a double top, which the algorithm is pretty much programmed to target that. So they're doing the opposite of what they actually need to do to win in the market. So, and this is just an example for relative equal highs, right? If you see that they're left untouched, right? You form a double top and you move, and it actually works because that's a probability too. You can use that as a target for your buys in case you end up getting into a buy and price starts to move up and you're happy. You can use that as a target for your position. Why? Because you know there's liquidity up here and there's a possibility that price is just moving up to target that and reverse. But most often than not, as I've just explained, you will get this scenario where you induce them, you move a little bit away, they start to get happy, and then you get them blown through. So yeah, that's everything about the visible liquidity in regards to the equal high, equal lows. So I'm going to remove all this, and we're gonna be looking at some charts examples, right? So let's move on into the charts. And I think, yes, right here we've got a beautiful example of a relative equal high liquidity being purged. So as you can see right here, we had price moving up, creates a high, moves away, come back. And as you can see, it's not necessarily exact equal highs, right? That's why we call them relative equal highs. In essence, what you know is that you have liquidity up here because you got a double top, 1 and 2. And as you can see, price moves away for a bit and then comes back up with this wick, takes them out, and the real down moves begin, right? So that's, I hope this should be pretty clear now what actually that visible type of liquidity we have in the market. Now, moving on into the hidden liquidity. Let's start by talking about the trendline liquidity. This is pretty self-explanatory. If you know what a trendline is, then you know what trendline liquidity is, right? What you will find is that sometimes when price is moving up, it's gonna move up in a very compressed and fashion way like this, right? And what price is essentially doing is creating trendline liquidity. Some people will identify it, will see that as a trend line, and they're going to be waiting for price to get down here, and they're gonna be looking for buys. And this is pretty much the same outcome as this type of liquidity, right? You will get the move down, they will get the mini reaction, and they will get the blown through. Because we've got plenty of liquidity down here, right? There's multiple stop losses across this area. So that's also something we can target as we can use as a target, right? It also helps us preventing bad or POIs that are not going to hold. For example, if I have a market structure like this, and I see that we've got trendline liquidity all around here, I'm not gonna be looking for any POIs to take sells at this point, right? Because I know that this right here is all liquidity, and the probability tells me that it's going to get wiped out rather than holding and dropping, right? So I would actually wait for the liquidity of the trend line to get wiped into a possible origin block that I can then safely watch for potential entries, right? So let's now look at a single example. I don't think we need much explanation here. So as you can see, I've already labeled this for you. We've got trendline liquidity right here. As you can see, this is a trend line. We've got multiple touches, 1, 2, 3, 4. As you can see, it doesn't need to be exact, right? You just need to identify with your eyes where the trend line liquidity is sitting. So this will help me if I'm taking sales. I know that I can safely probably get through all of this stuff because this is just liquidity, and I know that I can target lower. On the other hand, if I'm looking for buys, I know that I don't want to be buying any of these order blocks, whatever, right? Because those are liquidity, and the probability says that they're going to get wiped, and we don't want to take entries there. Okay, so now that we understand trendline liquidity, let's move on to the next type of liquidity, which is previous daily, weekly, monthly highs and lows. This is also pretty self-explanatory, so we can see on the charts. This right here is liquidity. Every major swing point, to be honest, right around here, right? Every major daily swing points, those are considered liquidity. Why? Because there's plenty positional traders that are looking to either, let's move a little bit back, that just like this, right? As you can see, we have a swing point right here, and there's people that have stop losses below this, above this, above this, below this, above every major swing point. We're going to have liquidity and sell and buy stops. So you need to keep that in mind whenever you're doing your charting. You need to look at the swing points mainly based on the daily, weekly, and monthly, and you will find those liquidity pools because that's what they are essentially. The third type of hidden liquidity is actually the Asia low, high, London low, high, New York low and high liquidity, right? You actually, as you can see here from my chart, I've got labeled an Asia high liquidity. If we turn the indicator on, that's the only indicator I use, and I use it as a visual reference. So as you can see, this is an Asia high that has not been liquidated yet. So I know that any POI inside this region is most likely not going to hold. Why? Because we've got liquidity right above it. So what they're essentially going to do is they're going to grab it into a real POI that is probably going to provide some good reactions, right? So that's why I'm not afraid to hold a position through a Asia high or low, because I know that most often than not they get targeted, right? And what you would do is, for example, you go here, you see this is a Asia high that has not been taken yet. You actually mark it up, all right, Asia high, and then you have it as a reference. You know that that is liquidity and that is something you can target. Same thing goes for London lows and highs. However, I don't have an indicator for that, so you're going to need to do the work yourself. You're just going to be looking at the London hours and identifying London highs and low points. Whichever those who are not liquided, you want to knock them down, and you want to avoid trading POIs inside that region. Why? Because they're not going to hold, because they're liquidity. Now that is pretty much, if we go back here and we remove this, that is pretty much all the different types of liquidity explained, right? Oh no. Okay. So we talked about this type of liquidity, we've explained trainline liquidity, we've explained this type of liquidity, which is the major swing points as explained. Important, you need to note them down as well. And the session liquidity. That's pretty much all the different types of liquidity and how to spot them on charts. And that's about it. You should avoid trading POIs or point of interest that have no liquidity grabbed into them, right? You don't want to use an order block or whatever you use to identify your POI if there's no liquidity grab into the block, right? Let's imagine this is your order block, your point of interest, and price just comes down like this, right? You don't want to be buying this because there's no liquidity grabbed into it, right? If you had an Asia low sitting right here, then yes, you could potentially monitor that POI to take entries. But if you do not have liquidity grabbed into the POI, you don't want to use that POI because it's mostly going to fail, pretty much. Now, what else can you do now? You can use liquidity pools as target, right? Now that you understand where liquidity is, if you happen to get into, let's say this down move, you happen to get into a buy position somewhere right here, and you know you've got trendline liquidity all around here, well, then that's going to be great for you because you know you don't have to worry about all the order blocks and POIs within this region because there are liquidity and they're gonna get wiped most likely, and you know you can go ahead and target higher somewhere around here, maybe at the origin of the swing, right? At the origin block. Those are the highest probability blocks, but that's for another video. Okay, so you can do that too. What else can you do with this knowledge is avoid fake POIs, right? You can now avoid fake POIs. Well, and you can do so because you know that order blocks or POIs within Asia highs and lows and London highs and lows, they're fake POIs and they're liquidity pools and they're not going to hold. Now let's take a look at the actual chart. So if we look at the chart right now, as you can see, I'm in a buy position, and I'm honestly, if price was to make its way up here, right? If price was to make its way up here, which I don't really know, right? With 100% certainty, I would not be worried about any POI here, right? Like you see this little order block, I wouldn't be looking for a sell here because this is liquidity, and with probability this is not going to hold. This is just a fake POI. Now on the other side, if we see here, right, if we've got, let me remove this quickly. We have trendline liquidity here as we discussed before, and as you can see, we've got an order block right here. If we drag it across, I can almost certainty guarantee you this didn't hold at all, right? And now you know the reason. Now you know why this order block didn't work. And potentially you can avoid it next time, right? It didn't work because it was sitting at trendline liquidity, and that's gonna get smashed. Now, if you follow all these simple principles, your win rate and profitability should skyrocket because you're going to be avoiding bad trades at fake POIs, at liquidity pools and all that stuff. Now you can focus on the POIs that really matter. Today's topic of discussion is going to be around order blocks. I'm gonna be explaining how you can trade order blocks in Forex effectively and successfully. If you trade order blocks, you've probably come across the issue before where you just see too many order blocks, right? You see too many of them all across your chart, all across multiple time frames, and you just don't know which one to pick, right? Which one is the one that's going to hold? Where should I focus on? And that kind of stuff. So I'm going to be giving you some rules and ideas on how you can pick the right one. But before we dive deep into order blocks, I'm going to be giving you a quick definition of what an order block actually is, right? So let's actually start with a bullish order block. Some people call it demand zone. It's essentially the same thing. So do not worry or get confused about that. And the bare bone definition of a bullish order block is essentially any down move or up move that leads into a BOS. It leads into BOS, right? So that's essentially your definition, and let's illustrate that idea, right? And for that, we're gonna imagine we have a downtrend, we have price pushing down, all of a sudden you get a reversal and price starts going up. So following this principle, this is your last down move before the up move. Again, last down move before the up move that leads into BOS, right? So this would be considered your break-in market structure. And this entire region right here is now your bullish order block, right? And what you will find most of the times, let's imagine this right here is a H4 time frame, right? This is a 4H time frame. What you will find if you zoom into lower time frames is you will see maybe a 30-minute order block right here, another one right here, 15-minute order block right here, and it can get very confusing, right? Because you will see multiple order blocks within that higher time frame order block region. But for now, that was just the definition of the bullish order block. And we're going to do the same thing for the bearish order block, which is essentially the same thing, just flipped the other way around, right? So bearish OB or as some people call it as well, supply zone is any up move or down move that leads into BOS. It's essentially the same thing, just flipped upside down. So let's imagine you have price pushing up, and all of a sudden you get a reversal and price starts to push lower. Following the same principle, right? This is your break in market structure, BOS, and this is your last up move for down move that caused this to break. So now we can safely say that, hey, this is our bearish order block. But just as with the bullish order block, what you will find is that you will probably have multiple order blocks within this region, right? That you can frame trade ideas on. So yeah, now that we've covered the main definition of what an order block actually is, let's now move on to the charts and keep discussing further ideas. Okay, so now that you understand what an order block actually is, I'm going to be open up a random chart on a random pair, and we're going to be replaying price action and seeing what happens, just applying the knowledge and the ideas I've taught to you before, right? So let's go ahead and do that. Let's open a random pair just like this, AUDJPY. Let's go to a daily time frame. Let's zoom out so I don't see what's actually happening. I can't see what's happening here. Let's go to a random point in time, something like this. Okay. And let's try to make sense of what's happening here, right? So what we can see here is the following, right? You've got a break in market structure right here, right? You got a BOS to the downside, which means that this last up move before the down move that caused the structure point to break is now your valid order block, right? So I would actually go ahead and refine it to the last point right here. This would be considered your order block. Why? Because this is the last up move before a down move that broke structure right here. So depending on the type of trader you are, you can actually be already in a sell, right? You can take a sell right here, put your stop just above the order block and target lower prices. However, I highly suggest you don't trade that way, because that's going to get you out of trades back and forth, right? Multiple times. So what I actually suggest is you actually go ahead, zoom on a lower time frame in here and look for confirmations. Now, the way you get your confirmations, there's multiple ways to do that, and you should actually try and figure out what works for you. But in essence, what you're looking to happen inside this region is the same thing, right? You want to see price would be coming up. You want to see a break. You want to see it a return into the origin of the swing that broke the structure, and then you're going to be looking for sales, right? But as I can see, this right here, this wick to the downside is a valid order block on itself. Why? Because what this wick represents is actually something like this, right? You had price coming down and boom, all of a sudden it reverses and leaves this wick. So this is essentially, if you zoom into a lower time frame, you can probably see an order block here, right? So I would actually mark the wick or maybe the 50% depending on how you trade, and you can actually go ahead and use this order block as a buy confirmation, right? Because this actually broke structure right here. As you can see, this let me do it smoother. This structure point got wiped with this wicks right here, and it came, the origin of this move came from here, right? So this was your last down move before the up move that broke structure, right? So what you can expect is some sort of mitigation or actual moves away from this zone. let's actually go ahead and let me give you some rules, right? Use high time frames OBs, and the reason for that is you will find that those have a higher probability of holding as well, right? Because they have more orders in them, right? As they are higher time frames, there's more price action within those blocks, and that means there is a higher probability of them actually holding, right? So that's one thing you can do. You can use high time frame OBs. The second thing I'll recommend you do is use use the closest OB to the origin of the swing, right? So to illustrate that, let's imagine downtrend, blah, blah, blah. Okay, so this right here is your break. This entire region, as I explained before, becomes your OB. However, you don't want to be trading the first one you see here or here or here, because you can have multiple order blocks here. So what you actually want to do is wait. You want to wait for the order block that's closer to the origin, right? This is your swing, this entire leg up, and this is your origin. So you want to be picking those order blocks, as those order blocks have the higher probability once again. And the third idea is probably going to be you want liquidity being grabbed into your OB, right? For the order block that you choose, you want liquidity to be grabbed into them, right? So let's imagine you open the charts and you see a market structure like this, right? So as you can see, this is your break-in market structure. This entire region, right, technically is your order block, but as I just explained, right here, you want to be waiting for the origin. And let's say you're waiting for your order block is here. And what you see here is we've got liquidity in form as equal lows. So you want to be waiting for that liquidity to get grabbed into your position, right? That way your order block is going to have a higher probability of actually providing you some great moves. So yeah, those are the three things I want you to keep in mind when picking an order block. Essentially, the first thing, right? This criteria actually depends on the way you trade. You can make lower time frame OBs work, but just as a general rule of thumb, you want to be picking high time frame ones, because those are higher probability because they've got more information and more orders inside of them. The second thing, you just wait for the OB that's closer to the origin, right? And the third thing is to actually see how the market is grabbing liquidity into your block. So yeah, I hope this was useful in regards to picking order blocks. Now, lastly, I want to explain to you the different types of order blocks, right? Because you have different looking ones, and I already touched on it right here when I explained you this. When I explained this order block to you, this wick kind of looking order block, and we're going to be discussing that. However, before we move on, you also want imbalance or repricing to happen into your order block, right? If you say this is imbalance, which means only buy-in, then the order block sitting below it is going to be great as an order block, right? And if you can have all these confluences together, your order blocks are going to hold most of the times. So yeah, I hope that was useful. And now let's lastly move on to the different types of order blocks. And I pretty much use three different looking ones, right? The first one you're gonna have is this one right here, right? Just a down candle before an up candle with all the criteria explained before, right? That's your order block. That's what we've been using all the time. The second type is the one I briefly explained before, which is this one, right? The one with the huge wick. That's an order block on itself, and you need to be aware of that. That's a valid order block. And some people call it FU candle, FU void. Doesn't really matter, right? At the end of the day, it's just another order block or point of interest. I would actually, most of the time, what I do with the order blocks that look like this is actually filter the first 50% of it and just stick to the last 50%, right? As I want to be trading the order blocks as close as to the origin as possible, as I explained before. So I would grab a fib maybe and just use that, because most of the times the 50% is going to get hit, right? Not in this case, as you can see. Whoops, I wanted to delete this. So price actually never tap into the 50%, and that's okay. That's going to happen as well, and you need to be okay with that. But yeah, that's the second type of order block I wanted to speak upon. And third, and not that many people use it, is, let me actually find a suitable example, right? I'm trying to see if we can get a good example. Yeah, this is an example right here. This on itself is a valid order block, even though the candle is blue and it's technically not a down candle, but it's part of this entire order block, which at the same time is part of this order block. But I would go ahead and refine it to this candle right here, because as you can see, this candle took the liquidity here and provided a break, right here, provided a break. So even though it's technically on my charts not a black candle, it's still a valid OB. And I'm actually curious to see if this one actually holds or provides some reaction. Yeah, as you can see, we go ahead and look here, we can see we hit that block and it provided some nice reaction. So those are the three ones. Again, I'm going to repeat them. This is the most common one, this black, the down candle before the up candles with the imbalance, right? Then, whoops, then we have the wick looking one, right? You see it's just a wick, but in essence, this wick represents this. It's the same thing. So this becomes your OB. And the third one is, where is it? Is it here? Yes. Is this one, which is essentially the same thing, just with a little bit more of refinement, right? We're going to be taking a look at mitigation, right? So the first question you may be asking yourselves at this point is, what is actually mitigation, right? What is mitigation? And to keep it short and sweet, mitigation is the act of smart money or central banks of closing negative positions out, right? And what do I mean by that? How would that translate into the charts? So let me actually go ahead and do that, right? Let's imagine we have a market that is consolidating, right? We're moving up and down, and all of a sudden you get a aggressive down move that leads into an aggressive up move then, right? So what is essentially happening here? Let's describe that first. What is happening here is the following. Smart money or central banks are selling very hard right here, right? They're putting a lot of money into these sales so they can then drive price lower for them to buy at a cheaper price to then resume the bullish move, right? So they're doing two things here. They're stopping people out, right, that have been buying below these lows. Plus, they're getting better prices for their positions, right? So what they actually need to do to achieve that is first sell very hard, then they get the better price, and then they buy very hard, right? And a good sign that you could potentially look for in order to identify if the banks were involved would be imbalances, right? If you see that there's plenty of imbalance within this up move, right, all the way up, that means that the up move was too aggressive and they probably didn't have enough time to close out the cells, right? The cells of this region and that are going to need to return at some point so that they can close those sales. Because at the moment, yes, they're making huge money with the buys, but the sales that they have right here, there might be some orders that still need to be closed before continuing. So now this is where mitigation actually comes into play, right? Because now you can justify to yourself a potential down move back into this region, right? You can say to yourself, okay, smart money sold here really hard, right? Now they bought over here, they have the better price, and now they're potentially returning to this region so that they can close out the sell orders that they needed to open here in order to drive price down so that they could get the better buy price. And yeah, we might be returning here so that they can have a chance of closing those positions out to then potentially continue higher, right? And if you combine that with imbalances, structure, confirmations, and that sort of stuff, that's where you get your high probability trades, right? If you say to yourself that, and you see, for example, that on your left side, while price is doing the retracement down, right, we have plenty of imbalance over here. We can actually talk about imbalances at this point because that's actually related to mitigation. So if you see that price is fulfilling imbalance, which is price inefficiencies, then yeah, that makes a lot of sense that smart money could have potentially sold very hard at this point to then buy very hard, and all they're doing is returning here to potentially continue on higher, right? So let's actually translate this region over here into candles, right? How would that look if you're looking at the charts in terms of candles? So we're going to be doing that. So that last sell, right? This sell move right here could potentially look like a huge bearish candle, just like this, right? You would have your bearish candle, and all of a sudden, right, you get a huge up move like that leads tons of imbalances, right? Maybe the next candle barely wicks down and continues pushing higher, and then and you can see it on the charts that you have imbalance all the way here, and that price really needs to return at some point, because all they did here was offer buy side, right? And the market needs to be balanced out. So at some point they're going to return here, and they're going to be offering sell side, right? Because that's how the market, whoops, let's actually imagine this is a red candle, because that's how the market actually moves, right? They're at some point in time, they're going to need to return here to fill all these inefficiencies in price, right? And they're going to be combining that move down with potential mitigations, right? And this is where actually mitigations comes into play. If you have a potential demand zone at this region, right, you can physically see how price may drive into that and retrace a bit, right? It's going to be rejecting that zone multiple times, because that rejection of the zone signifies positions being closed. Sell positions that were in the negative right here at this point are being closed at this point, right? As they're returning down and they're hitting the block, they're closing those out so that they can continue pushing up and making money on the better buys that they got at this point in peace, right? Now they don't have a sell position that they need to hold with potential billions of dollars in drawdown. So yeah, that is technically mitigation. Mitigation is essentially that. It's when you're seeing price hitting a POI and you're physically seeing on the candle, so it's getting rejected a bit, maybe a huge reaction, right? But then back up very quickly and then aggressively move down. So that would be mitigation. It's not complicated at all. All you need to understand is that mitigation is the act of the central banks closing out the negative positions, right? In order to continue in a given direction. All they're doing is essentially closing the negative positions out, right? So that they can keep making money in peace in whatever direction they actually want to drive the price. So let's actually now take a look at the charts, because I think this is pretty interesting, right? As you can see, I had this POI region marked at this point, and if we look here, we can see what I was actually explaining, right? We can see the move down where they sold very hard so that they could have a better buy price to then drive price up, right? You can see here how then price aggressively moves up. So now what they need to do, as I said before, is at some point in time, they're going to need to return here. And as you can see, I was watching this POI, and if we, for example, zoom in, you can see the rejections, right? One candle, one candle rejecting here, the other one here. That means that they're closing their position out, right? I'm not saying that price cannot go deeper, right? And potentially into deeper demands. As you can see, I also have another demand zone or order block marked at this region, right? So we never know how far they need to mitigate, but as a rule of thumb, you would always see most of the times at least a 50% mitigation, right? Because they are going to need some time to close all those positions out. So if we zoom into even lower time frames, right, maybe even a 5-minute, we can actually see how price is hitting. As you can see, price engineered liquidity just above it, grabbed it on the way down, right? And now we're mitigating, let me remove this. Now we're mitigating those orders and we're rejecting the zone, right? You can see those rejections, potential move to the other side, right? Even lower time frame, we can see how they're mitigating those orders out, and now they have potentially shifted again, right? So that they can continue making money on the overall direction, which is essentially, if we account this move as the origin, up, right? They may never even return here, right? We never know how far they're going to need to mitigate. So that's essentially that in terms of mitigations. There's really not much to it, right? You just need to monitor price, right? If we draw it out like this is your POI, right? Let me do it better. Let me remove this and we go to a cleaner zone right here, right? This potential up move into the up move. You would have your zone here and you would see the imbalances on the way up. You would wait for the retracement to say, and you say to yourself, okay, we're being efficient now, right? We're offering sell side on a price point where we only had buy side. So now that we're here, I have a reason to believe that there could be a potential up move, right? You now can watch the lower time frames. You would see how they're rejecting, boom, liquid. This is a very liquid area, right? Because they are closing positions out. You would actually see how they're closing them out, and you would see potential bullish moves away, right? And once you get your confirmations, right, you can say to yourself, okay, we may have potentially finished closing those positions out as we're starting to see buying pressure again. So I may want to try and get a position somewhere over here so that I can continue with the overall trend and with the central banks and make money. So yeah, that is it in terms of mitigation theory, right? There isn't much more to it. It's just the act of seeing how they're closing those negative positions out in those areas of interest, right? However, there are two different possibilities and scenarios within APOI, right? And we're going to be discussing those, right? I'm pretty sure you might have come across the scenario where, and this is scenario number 1, and this is called a very liquid POI, and this occurs when the POI is very liquid on itself, right? You would have potentially price moving up and price hits the mitigation block and drops aggressively, right? It drops aggressively. It won't play around inside this region. It just drops very aggressively away, right? It will not give you a chance to enter, and that's okay. That's going to happen sometimes, right? Sometimes price isn't going to be giving you your perfect entry so that you can get in with them and make money selling in this case, right? So that's one of the scenarios where the POI itself, the region you're waiting on, is pretty liquid on itself because they may have grabbed a lot of liquidity on the way up, so that they have enough fuel now to just hit the block and continue selling. There's no need to play around inside this region or distribute or accumulate or whatever you want to call it. They just hit the block and leave because they don't have any reasons to stay there any longer, right? And the second scenario, and the most common one, is actually a non-liquid POI, right? This is what happens most of the times. You will have a non-liquid POI, which means that price would be coming up, just like this. Price would be coming up, and because it's a non-liquid POI, they need to engineer the liquidity here inside this region so that they then can shift, right? So you would see price moving up and down, maybe creating some sort of fake resistance for retailers. They would maybe move away a bit. Retail will get into sells very hard. They will start selling, and all of a sudden you see that price comes very aggressively up, takes the high out, and then moves down, right? Because it was a non-liquid POI, and they needed to engineer the liquidity first so that they can then stop those people out and continue selling. So yeah, those are the two different scenarios of mitigation you can potentially get, right? It's all about watching how price behaves inside a POI, right? The more you do it, the better you're gonna get at it. The more time you spend watching how price is rejecting those areas, potentially breaking short-term structure, you are going to have more confidence in executing those positions with the tiny stop loss right below the lows in this case, and bigger targets, right? Now, what you may be asking yourself at this point is, what is institutional order flow? And to give a quick and brief definition so that each and every single one of you can easily understand it, institutional order flow is the act of smart money and big banks of constantly introducing buy and sell orders to the market, right? What you need to understand is that the people that are moving a particular price, they are constantly buying and selling the market, right? They're not just buying it or not just selling it, right? They're selling it at this point, they're selling it over here, they're selling it over here, here and here, and so on and so forth. You get the idea. And they're buying at those points as well, right? They're constantly introducing buy orders and sell orders. Now, when a particular market, just like in this case, is pushing up, what you can deduct is that whenever they're introducing buy orders, those buy orders have bigger volume, and for that reason, the price is pushing up, right? Now, the reason why price is pushing up, that may vary across different scenarios, right? You may have a equal high liquidity sitting over here, and that's the reason why price may be pushing up to target that and take that out. Or you may have trend line liquidity all across here, and there's multiple stop losses, and for that reason institutions are introducing more buy orders, right, to take that out. Now, another thing that I want you to understand is that there is no human interaction whatsoever, right? You and me, even if you think that you're throwing in 100 lot on gold, right, that is not going to be affecting price at all, right? You cannot expect just because you threw in 100 lot buy on gold that now price is going to go up, right? That has no impact or influence at all on what price may actually do. Everything is actually pre-programmed and predetermined by an algorithm, right? From the first candle of the day to the last candle of the day, everything was pre-programmed and predetermined by the algorithm. Another thing that you need to understand is that there's no human interaction whatsoever, right? There's no human sitting at a big bank. Let's, for example, imagine we're looking at a currency such as GBP USD, right? Now, you may be asking yourself, now, who controls this market? Well, it's pretty obvious that the people who are moving the market in this case are going to be the ones that own the currency, right? In this case, the main currency here is GBP. So the Central Bank of England is the one that is deciding where GBP USD may be heading in a particular day or what may happen with the currency, right? The Central Bank of England is the owner of the currency and has the power to actually decide what's going to happen, right? So what I want you to understand is that there is no human actually deciding, well, we're going to be buying GBP USD today or selling it today, right? Everything is actually pre-planned and pre-programmed for them, right? They just be maybe following certain instructions or guidelines. However, they do not decide what price is going to do. Everything is actually determined for them. So the concept that we're going to be discussing now that is going to help you with understanding institutional order flow and actually tracking where institutional order flow is sitting is called LPOTM, which stands for last point of true mitigation, right? If you want, you can write this down. This is a concept, right, that is going to help you a lot in tracking institutional order flow and actually seeing where the interest is sitting. So let's actually get started with that. And for that, let me remove all this and let's now draw a potential bearish trend, right? So this is a bearish trend. We can all agree that price is pushing down. And what is the last point of true mitigation? Well, it's pretty simple to understand, right? Each and every single time you have a break in market structure, your eyes should be instantly magnetized to the origin of that break, right? Which is, in this case, is this. And if we look closely, we can see that this up move actually mitigated this previous structure right here, right? So now we can actually deduct and understand that the interest in this market is sitting right here, right? This is where they last actually introduced a majority of sell orders, and this is where the interest is protecting price, right? So now we can go ahead and label this, and I would suggest you guys do this whenever you're trying to track order flow in your actual candle charts, right? So this would be considered your last point of true mitigation, right? And this information is going to help me a lot in tracking order flow, right? Because now I know that all these POIs over here, right? This potential those potential order blocks all across here, they have no relevance, right? They can get easily taken out, right? Into the last point of true mitigation. As long as we're holding this point right here, we're still bearish, and the interest and your bias should still be bearish, right? So what you can expect is that price can return to that last point of true mitigation, and once we get there, price may actually continue and resume the overall interest, which in this case we can see that is clearly down, right? Let me actually save some space to keep illustrating that. So now you would update your last point of true mitigation, and now you can understand that, hey, this is where we lastly mitigated, right? We broke structure over here. We mitigated this previous, let me actually mark it. We mitigated this previous block, and now we've actually returned over there, right? We can see it here. We've returned here. This is now the moment we get the break in market structure again, you can assume that this structure right here is where institutional order flow is holding, right? So you can go ahead and update this. This is your last point of true mitigation. And you can keep doing that back and forth, right? As long as you don't break that structure point, you're still valid for sells and you can still expect sells. Now, the moment that gets breached, then is where you can have a potential shift, right? If you then break that point, you can now safely say that, hey, the institutions have no longer interest in selling the market. Why? Because if they did had interest in selling the market, they would have protected this high, because this is where they last mitigated, right? If you see the line across here, it connects one structure point with the next one. So if they wanted to keep making money selling, they would have protected this point, right? And they would have actually continued lower right there instead of pushing up. But since they broke structure to the upside, you can now assume that the overall interest of this market has shifted from bearish to bullish. Now, I know you now may be asking yourself, well, following the principle you just explained, right? This is a break in market structure right here, right? This low getting broken over here. And this is a return into the potential origin of this fractal structure over here, right? Then how can I filter those points of mitigations that actually have no relevance and are not going to hold? And the answer for that is actually looking at structure, right? Structure will always give you the keys and will always tell you where we're potentially heading, right? If you would have paid attention to structure, your structure could now look something like this, right? You may have the origin over there, you have the low over here, you had the mitigation over here, you made a new low, and you're potentially now shifting bullish, right? And if you look at this particular price point, what you can identify is that this is just internal structure, right? This has no relevance at all on what the overall higher and external structure is actually doing or playing. And again, if this sounds confusing, you can always revisit my video on structure, because I go very in depth on that concept over there, and that's going to give you a lot of valuable information. So yeah, that's that in regards to the concept of the last point of true mitigation, right? It's a pretty important concept. It can help you a lot in tracking the institutional order flow, but you should not use this alone to take and frame trade ideas, right? You need to have the confluence of you need to have a confluence of structure, liquidity, POI, confirmations, and that sort of stuff. Yeah, it's a puzzle that you need to piece together in order to make everything work. I'm just now giving you an extra tool that you can use to track order flow in this case. So what I suggest everyone do, and this is something that I regularly do with my private group, and that's something that's going to help you a lot in tracking order flow, is let's delete all this stuff, is potentially go to a very volatile pair such as gold and watch the 1 minute time frame, right? And you will actually see how those points of mitigations actually hold, right? Following the principle, let's do it like this. Let me actually do it better, right? So we have a structure that can potentially look like this, right? We can draw it like that, potentially higher. Okay, so now you say to yourself, this is a break, this is my origin, and the moment we mitigate here, right, and break structure higher, this is considered your last point of true mitigation, right? And you can keep tracking order flow back and forth inside the 1 minute time frame. And yeah, you're going to be doing that, right? The moment this point of mitigation breaks structure up, you can now expect that the institutions are holding price right there and that there is no interest of going lower than that, right? And for that reason, as you can see, price returns here, mitigates the last point of true mitigation, and now this becomes your last point of true mitigation, right? And if you look at a very volatile pair such as gold, you're going to be seeing that happening back and forth, right? And that's going to help you in tracking order flow, right? However, one advice and something I will tell you is that you want to be using higher time frames, right? You want to be using the higher time frames for this type of concept, if I'm being totally honest. And the reason being is because higher time frame actually it takes more time to develop a candle, and for that reason, that particular candle has more orders inside of that candle, and that means that there is a higher probability that that is going to hold, right? Rather than a 5 minute last point of true mitigation, right? You will always want to be using higher time frames, because even though the market is fractal and essentially everything occurs in every single time frame, right, back and forth, you want to be using the higher time frame ones because those have more orders and in essence more information and hold more weight, right? So yeah, that's that in regards to the technical explanation. And now we're going to be moving back to the charts so that I can illustrate the points even further, right? And actually translate all this information into candles so that you can have an idea of what it actually looks like when you're trying to track institutional order flow. Okay, traders, we're now looking at the charts. This is gold on the 5 minute time frame, and we're going to be trying to translate the ideas and information that I just gave you before to the candles, right? As we usually do within this video. So let's actually get started. And as I said before, this is a 5 minute time frame, guys. This means that each and every single candle duration is 5 minutes. So the information and the amount of orders that these candles have is not going to be as precise and as valuable as a 4 hour or 8 hour or daily time frame. That's something that you need to understand. And what you will see happen within this price action is that you're going to be seeing price shifting from bullish to bearish back and forth, right? Without much explanation. But that's why I said that is a good practice to look at the lower time frames, because you're going to be seeing order flow shifting back and forth within this time frame, and that's going to lead you into a better understanding of the concept. So let's actually get started. We're looking at gold, and we're going to be trying to find an example that can be suitable. This is actually good right here. So ignore all this previous noise. Let's start right here, right? So you have a low right here, you have a high, we have a break. So this is now your impulse, right? Now, following the concepts that I've been teaching on this channel, you would wait for the origin to hit. This is exactly what happens at this point, right? So now, with the understanding that we have now, we can now safely say that, hey, this entire block right here, and you can use this line on the top and this one on the bottom, right? If we actually get the tool, this entire region right here is your last point of true mitigation, right? And as I explained before, this is the last point of true mitigation because this is the last mitigation that actually came to the origin and led to a break in market structure right here at the top, right? So now we can safely say that, hey, this is where we last mitigated, right? And what I actually like to do is grab this tool, connect it over here, and name it. This is now your last point of true mitigation, right? This point right here is where order flow is sitting, right? We can safely say that the interest in this market is to protect this low and continue making money up. If we're just taking into consideration the 5-minute time frame, right, without looking at the overall picture, which is essentially something that you should do and what I suggest you actually do. So now if we drag this across, let's actually see if this holds, right? The theory tells us that now this is going to hold if they want to keep making money selling. So let's drag it across and let's see if we ever return inside this region, right? From the top to the bottom, right? This is our region where the last point of true mitigation occurred. And this is where we could be expecting potential up moves away, right? So if we drag it across and we zoom it here, we can actually see, even on the 5-minute, how price returns inside this region and continues higher, right? We can safely say that, hey, this was the last point of true mitigation, so we drag it across, and now that we've mitigated again, we can update this, right? As I was telling you before, this was our previous last point of true mitigation, right? We can maybe put it back over here, and now we can say that this entire block right here from the wicks high, to the wicks low is your new last point of true mitigation, right? This region right here from the top to the bottom. This is now your new last point of true mitigation, and you can go ahead and name that last point of true mitigation. And yeah, this is pretty much the theory. Let's actually see if this ever holds or not. So if we drag it across, we can see that we tap into it right here. We move away for a bit, right? We potentially shift, but then we resume bearish. And the reason being is because this, once again, this is, this right here, right? If we look over here, is the 5-minute time frame, and this is not good enough of a information for you to frame trade ideas on, especially only looking at last points of true mitigation. As I said, it's just a tool for you to track order flow, right? So we can clearly see this actually fails, right? And we continue lower, and that's fine. That's going to happen, especially if you're only looking at one time frame. So let's do one last example over here. We can say this is a low, this is a high. We break this internal structure, and now we have this order block, right? And as we can see, this is our last point of true mitigation, this entire region right here. So let's remove this quickly. Let's remove this. And let's actually go ahead and draw it out. Now we understand that this price action mitigated the block, so this becomes now our last point of true mitigation. And as we can see, price actually returns here and continues higher. So yeah, even on a 5-minute, this can actually work sometimes, but you need to be taken into consideration all these other factors that I've been telling you all the time, right? Structure, liquidity, POI, confirmation, time is also pretty important. The Euro USD pair and the DXY are going to be most of the times inversely correlated, right? And we're going to be taking a look into that in just a second. But for now, understand that, right? These are the currencies that the DXY is being measured against, and the euro is the one that is having more influence into that, right? So with all that information, guys, we can now quickly go back to the charts. And if I actually split my screen in two so that I can fit two different markets, right? You should understand that we have the DXY to the right on the 1 hour time frame. Let me actually add the Euro USD on the 1 hour time frame. If I put them like this, just side by side, take a second, pause the video, and actually type in the comments below what do you realize, because there's specific information here that is relevant and important, right? Let's actually pause the video and try to identify what can we realize as we're looking at these two different markets. So if I actually go over here and invert the scale, you will see that very clearly, right? You can now understand, and if I actually zoom out a little more, you can see how similar these two markets look as I inverse the DXY, right? So this is pretty powerful, right? Because now if we actually flip the DXY back up, we can now realize, for example, if we look at this mitigation, right? This happened 9th November, 5 a.m. in the morning, right? And we look at Euro USD during that same period, which is over here. You can see that that is being shown to the left with that dotted line over there. You can see that, and let me actually grab the tool. Where is it? This one over here, that as the DXY was mitigating this origin block over here, right? We have some trend liquidity being taken. We have a new high being established. We have a retracement leg being built down, right? We can see how order flow is shifting as we're creating that retracement leg. You can see that as we mitigate this block over here, the the Euro USD pair is exactly doing the opposite thing, right? We look over here, we have the same thing occurring. We have a potential lower high, we break structure over here, right? We create a new lowered low. Now we're retracing, building that bullish order flow over here, right? Same thing is occurring. We're building that bullish order flow here. And as Euro USD is hitting this supply zone, bearish order block, whatever you want to call it, you can realize that the DXY index is hitting that opposing demand zone, right? And is potentially shifting higher, which is essentially the same thing that occurs with the euro, right? We hit the supply and we start moving lower, and at the same time the DXY starts moving higher because they are correlated. And if, as a general rule of thumb, is the Euro USD is going up, the DXY will be going down. So how can we use this information? Well, now the next time you want to be trading Euro USD, you can have that DXY pair to your right, and you can look for that confluence in information, right? If you want to, let's say, take sells on Euro USD, right, for whatever reason that may be, let's say you were watching this POI over here, you can simply confirm that the DXY is also hitting some sort of valid demand zone. Once again, you want to be seeing the opposite. You want to be confirming that the DXY is hitting some sort of demand zone, and that is also shifting and potentially moving higher. Then that would mean that the Euro USD dollar will be moving down, and now you can have more confidence and more information in regards to what you can expect to Euro USD to occur, right? Because you can simply just wait for these two things to line up, and now you have more confluence and information. But once again, you don't want to be blindly doing that. You still need to be in the right Euro USD point of interest. If that is not the case, then well, you can get a reaction over here, right? And I'm sorry, this is getting pretty messy. Let's see if I can get rid of some of the stuff. Oh, I actually can't. So let's just do it like this. So as I was saying, guys, you still want to be assessing structure, liquidity, points of interest, all that sort of stuff, right? But if you see that your USD is hitting supply or an area where you're interested in getting involved, you can now simply add to your analysis and confirm that the DXY structure, liquidity, points of interest is also making sense for it to be doing the opposite thing, right? Because if it's not making sense, then it's not going to shift and it's not going to give you your trade, right? So please understand that information because that is really powerful. And just as a little bit of more information, the DXY generally follows the daily cycle theory very well. So you can also be assessing that, right? And another tip that I will give you with the DXY is that the DXY tends to shift market direction much faster or even sooner than the Euro USD will ever do it, right? So if you see that, let's look at this example specifically. We can identify this point of interest, the DXY trades into that, and then you see the shift occurring over here while let's say that the Euro USD is still working on this mitigation that actually occurred last week, then you can take an early entry because you see that the DXY has officially shifted back up, so you can expect that the Euro USD will follow because most of the times, and we're going to be writing this over here, DXY sets direction, Euro USD, Forex, whatever you want to call it, follows that. So if you're ever unsure if that particular point of interest that you're watching in your Euro USD pair is ever going to be holding, you can always assess what DXY is doing. And if you see, hey, for the DXY at this point in time, it makes perfect sense for it to continue up for the reasons that we've been explaining before, such as the trend line liquidity building, right? The expansion that we can see over here, the creation of that new high, right? The establishment of this potential higher low and the retracement that is potentially coming to an end as we're trading into the block. And you can see that your USD was doing the same thing, just literally the opposite, right? Your USD was creating that low instead of creating that DXY high. Your USD was creating that retracement leg back up, while DXY was creating that retracement leg back down. Your sort of DXY shifts and starts going bullish. Your USD takes a little bit more of a time, but essentially does the same thing and provides you with this sell-off while DXY is literally flying over here, right? So that's why it's always important to leverage the news reports in regards to the US dollar in some sort of degree, right? You don't need to be the fundamentals expert to trade the way we view the markets, but you still want to be assessing and avoiding trading during high impact news reports or leveraging that information into your advantage if you actually have the ability to do so, right? So once again, guys, I'm just giving you some information and examples into what you can be doing with the DXY and Euro USD correlation, right? Just to give you one more example, you can be using the DXY as a measure for your targets, right? Let's imagine once again, you've got involved in buy positions over here, right? Let's say that this is a reasonable target over here because you understand that this is the opposing end of the range and you can never be sure if that's going to be taken out or that is going to be respected into continued sales lower, maybe into the origin over here to then possibly continue up, but you don't want to be taking that risk. You actually decide, hey, I'm going to be taking profits over here. Where? Well, if you look at Euro USD, you can see that this block over here represents this bullish block over here. So now, when you're taking that Euro USD sells, you can understand that, hey, as the DXY is hitting that block, Euro USD should be hitting this one over here, and I'm going to be partialing, taking profits, whatever you really want to do, right? So understand that, right? The DXY tends to sort of do what the Euro USD will eventually do faster, right? Just in the opposite direction. Understand that the DXY is more likely to hit this block faster than the Euro USD will ever do it, because it tends to move quicker. The main takeaways here is that the DXY is mostly correlated with the euro, so trading the euro US dollar and having that DXY confluence is a very smart idea, right? And something to follow. So the first session you will have is the Sydney session, which will start at 10 p.m. and ends at 12, right? It is a 2-hour window. The next session will be your Asian session, which essentially starts just when the Sydney session finishes. It will be 12 until 6 a.m. in the morning. It's a 6-hour session. Then you have your Frankfurt session. This starts at around 6:15 and ends at 7:30 a.m. After that, you have the London session, which starts at 8 a.m. and ends at 3 p.m. And lastly, we have the New York session, which starts at 2 p.m. and goes on throughout the remaining of the trading day. And then the Forex market repeats itself, and you start again with the Sydney session, and you go through the entire process once again another day. So let's now get into the specific characteristics and different chart ideas that you can recognize in order to frame your trade ideas. Let's actually start breaking the Forex daily market cycle down. Now I'm going to be using the example of a bearish day, and do not worry, we will get into the charts once I finish the entire process, but this will take some time, so have some patience and take as much notes as you can and really try to gather as much information and value as possible. So as I said, I'm going to be using an example of a bearish day, but it would be the same thing for a bullish day, just flip the other way around, right? So let's actually get started. So let me print for you a potential Sydney range, Sydney session, right? So let's imagine this right here is your Sydney session, right? This bit of price action. So let's actually label it Sydney session, as we said, from 10 till 12. And this session is pretty important. The reason being is because during this time period is where the algorithm actually resets and a new trading day begins. And for that reason, what you will find is that most of the times you won't get much movement throughout this time window, right? Because the algorithm is resetting and it's getting ready for a new trading day. Great. Now that you understand that, it is also important to keep an eye on the Sydney high and Sydney low, because those are liquidity pools and you want to be paying attention to that. So as we said, we were doing the example of a bearish day, and let's imagine the Sydney session is printed already, it's already done, and now, as we said before, we would move on into the Asian session. So let's imagine the Sydney session is now done, and as we said, we have a bearish day in front of us. So what you will find is that the Sydney high will get taken first. This is pretty important. You will get the Sydney high rated first into a important point of structure or liquidity or maybe imbalance, right? Essentially, the Sydney high will get rated first into a imbalance fill or liquidity grab to then go ahead and grab the Sydney low. And all this is happening during the Asian session, right? So let's keep printing the Asian session. Let's use a different color just to help you guys out. So this would now be your Asian session right here, right? This is your Asia high, and this is your Asia low. And now let me give you some quick and key things on the Asian range, right? If you haven't watched my video on the Asian range, I highly suggest you do so because it has great and valuable information. But let me refresh some stuff. So what are important things inside of this range, right? We have the equilibrium point of the range, which is essentially the 50%, and you will find that you will have a lot of price interaction, right, in this region. Another important thing is that with probability, and this has a high probability, you will get this Asia low or high printed anywhere between 2:30 till 3:30 in the morning, right? Whoops, 3:30 in the morning. That's the time window for your Asia high or low, depending on how the range is actually developing. So yeah, that's pretty important and pretty powerful if I'm being honest, because if you know that you will with probability get one of the landmarks printed throughout this time, then you can actually frame trade ideas around that, right? If you see, for example, you have the Asian range coming down and you are approaching, for example, an order block here to your left, and it's getting close to this time window, then great. You know that this POI mitigation right here can probably be the Asia low to then continue up. And this is a key, and this is something that I've been using for a very long time, which has made me tons of profits, right? This is where you have time and structure and liquidity, everything lining up. And this is where you get those great trades. So let me actually get rid of this because I need the space. And if I can delete this, that would be great. Let me actually do that because I want to make it smooth as possible. So let me redraw it. Okay, this is not much better. So, okay, now that you understand that, and you understand the importance of the midline within the Asian range, let's go ahead and continue with Frankfurt. If you have a bearish day ahead of you, as we've been talking all the time, Frankfurt with probability will rate one of both sides, right? During the time window of Frankfurt, one of the sides will get rated with a very high probability. So let's imagine Frankfurt kicks in and the Asia low gets taken out, right? Because in that particular daily cycle, the Asia high was protected. Now that we're moving on into the Frankfurt session, let's imagine that, whoops, I don't need this. Let's imagine this is your Frankfurt session, the different color. Just as I said, you would get one of the landmarks liquidated. And yeah, there's not much to Frankfurt. All you need to do to know is that most of the times it will just liquidate one of both sides, right? Depending on what kind of day you're getting. But most of the times, let me actually write it down. Say Frankfurt goal of Frankfurt is actually liquidate one side of Asia. Nothing more, nothing less. All you need to be aware about when you're trading Frankfurt is that you actually want to get a move into the liquidation of one of both sides. Okay, so that's Frankfurt then, and that's Frankfurt right here. Let's continue with the London session, and I actually just noticed that I forgot to label the Asian session, so let me go ahead and do that. Asian session, right? So now Frankfurt is done, you're moving into the London session, and if you have the scenario where Frankfurt just rated the low and ignored the high, and you're in a bearish day, this is important. What you will find with London is that you will get a test of the midline or any POI around the midline. Now again, this is pretty powerful and important information, right? You move into London, London comes up, maybe tests some order block inside close to the equilibrium point of Asia, right? You come here, you test it, and as we said, we have a bearish day. You will then get bearish continuation. You will get bearish continuation throughout the London session. So let's use black for the London session. Whoops, not this. We want the square. And let me actually label it. This is your London session. And again, if this sounds pretty confusing, do not worry. I will open up the charts later, and we're gonna take a look at that as real price action. But for now, I need you to understand the key principles and concepts and ideas of each and every session, because that's going to be crucial to your trading. So now that we understand this is the London session, and since Frankfurt rated the low and protected the high, you know that London with probability is going to keep the high and is going to keep dropping lower. Great. And after this, as we said before, you've got your US session. However, there is a key time before that, which is with this London US cross. Wow, this is so tiny. I want to actually make it bigger. So give me a second. Just like this. There is a key time which would be 12. And that would represent London US cross. And depending on how much liquidity they actually gathered with the previous moves, you can get a reversal during this period of time, right? There's a probability that you can reverse and actually continue higher. And let's actually move on to the New York session. And the New York session, again, if we are in a bearish day, in a bearish bias, what will happen is the same thing, right? Pre-New York will most likely, and we're going to use this color for New York, will most likely induce people to keep selling, right? Maybe have a little break below lows, and it will induce people to sell. But what you will find is that most of the times you will get and it's not going to be a progressive move up. It's actually going to be a huge move to stop all these people out, and then you will get the continuation, right? That would be your US session. Again, if London was bearish, you will probably get a huge liquidity grab just before the US session to then continue. Just because the market and the smart money and market makers, whatever you want to call them, they don't want the retailers to profit, so they will go ahead and sacrifice some capital to buy it all up to then quickly sell it all off, right? So yeah, those are the key principles within the daily market cycle. So as we said before, let me actually grab black as a color. We start with the Sydney session, which is when the algorithm resets. And in the scenario where you have a bearish day, as we said, you will get the high liquidated into the low. And that would be pretty much the Sydney session, right? It will just create liquidity on both sides of the market. Then the next session, which is the Asian session, will rate both sides. I've never seen the case where the Sydney high or low is protected. That usually won't happen at all. So you get the next session, which is Asia. It will rate the highs and lows of Sydney. It will create liquidity, and it will create a range. As we said, you want to pay attention to the 2:30 till 3:30 a.m. time window and the midline, which is the equilibrium point of the Asian range. After that, you will have Frankfurt, which will essentially rate one of the sides. Doesn't matter if it's the low or the high, you need to create your story around that, right? So essentially Frankfurt, as we wrote here, the goal is to liquidate one side of Asia. Once you've done that, and depending on the situation, London may pull back to the midline or any POI around the midline and continue selling off. Then US, the London session, the New York session, just before it starts, it will do a huge liquidity grab, sacrificing positions and capital to then continue the sell-off in the intended direction. Okay, so I hope this explanation was useful. Oh, lastly, the London US cross, you can get a reversal during this period of time. That's a probability too. So I hope this was pretty useful. That's actually and not confusing, because I know this is not easy stuff, but this is pretty powerful information. So with that being said, let's continue with the charts and let's actually break one daily cycle down from start to finish. Okay, traders, for this last section of the video, I will be breaking down an example of a daily cycle. We're looking at Euro USD on a 15-minute time frame, and I will just try to look for a suitable example and apply the knowledge I just provided you before, right? So as I previously said, there's multiple variations. You're not going to get it exact right off the bat, but you need to practice this stuff. Once you start practicing this stuff, your eye will get accustomed to looking at those specific ideas and it will be much easier, right? But for now, let me try and look for a suitable example. By the way, these boxes represent the Asian range. You can use this indicator right here on the top left corner to get it. Just make sure to adjust it to your time zone so it covers, as I said, from 12 to 6, because that's the Asian session. Now let me find a good example where we can discuss some stuff. Okay, so okay, I see a good example right here. Let's break this day down, right? So as I explained before, your day starts with the Sydney session. The Sydney session begins at 10, so you go ahead and put a vertical line right there till 12. Great. Now that you identified your Sydney session, we can box it just like this. And now we can delete this and just make sure to account for the high and the low. And to be honest, what I would actually go ahead and do is label it, because it's going to help your eyes a lot. It's going to guide them. So now we know that this is the Sydney high and this is liquidity. This is the Sydney low and this is also liquidity. Now that we know that during this time the algorithm is resetting, and that's why you don't get any movements at all, right? It's just side by side candles. Now, once the Sydney session is done, the Asia session begins. And as we can see, once the Asian session kicks in, we raid the high, right, into structure, imbalance right here, right? The distance between this wick and this, oh no, this imbalance actually got filled. So you only have selling during this period, and that's what you actually want to fill right here. You actually get that. And once you rate the Sydney high with probability, you can probably take a sell right here to rate the Sydney low, right? I tried trading this period of time multiple times, and just with the ideas of the Sydney high and Sydney low, you can get some pretty good trades, to be honest. So we rate the Sydney high into the Sydney low, right? Right here, you see how this symmetry lines up. We just reach below this low, which is the Sydney low. Okay, so now that you understand that, let me remove all this. Whatever, we create our range in Asian, and as we said, important landmarks of Asia, the midline. As you can see, we've got tons of price interaction at this point, and the time window of 2:30 till 3:30. So let's actually see if this lines up in this case. And yeah, as we can see, you get the Asia low printed right at 2:30, right? This is not random. This is not coincidence. This is actually how the algorithm operates, right? We create the Asia low at 2:30 in the morning. We move up for the rest of the Asian session. Great. Now, after that, Frankfurt kicks in, and as we said before, the goal of Frankfurt is to raid one of both sides of Asia. So that's exactly what we get in the cycle, right? We get the Asia low raided right here until London. Right here, 8 a.m., this is where London opens. So far, we've taken the Asia low, we haven't taken the high. However, this Asia high is not protected by any means, right? In order for an Asia high or low to be protected, it literally needs to be sitting at the edge of the structure point. Literally at the very edge if you want the Asia high or low to be protected. So as you can see, Frankfurt kicks in, rates the low, London just retraces, and boom. As we said, we hit a POI right here close to the midline, and we moved down, right? However, in this case, we didn't get the London expansion where it breaks the Frankfurt low and keeps dropping. In this case, we actually got a reversal, which will be absolutely fine, right? As you can see, we've been getting compression here. That's a sign for you that maybe we're not getting the expansion further down. So yeah, that was just a quick guidance on how to trade the daily cycle, because it has very good moves, predictable moves, and your job as a trader should just be trying to catch one of those potential moves, maybe wait for your best opportunity and execute on that. But as you can see, these concepts actually hold weight and work. It's up to you if you want to study it, put in the time, put in the effort, and see the results, right? Multi time frame analysis. And you may be asking yourself, and what's analysis? How do I do that? Well, that's pretty simple, right? Let's imagine you're first opening a chart of a market you want to trade. So in this case, we're going to be looking at crypto XRP. And what you want to do is essentially start with the higher time frames and work your way down into the lower ones, right? So for example, you would start with a monthly chart, right? And once you understand the picture and what the monthly chart is actually doing, then you can continue with the weekly, then the daily, and so on and so forth, right? Then maybe a 12-hour chart, then maybe a 4-hour, right? And you want to be doing that. Once you understand what is happening here, you can put a check and continue with the next time frame, right? And you won't stop looking at different time frames until you completely understand where do I want to execute in this market? What am I expecting? Where are we heading? What is happening? What is the most probable scenario next, right? Those questions you need to be asking in your head, and you're going to need those answered before proceeding with any executions, right? You need to understand the monthly, the weekly, the daily, and all the way down until you're happy and satisfied with the information that you actually gathered throughout those time frames. So for example, you would open up the monthly chart. The monthly chart may be doing something like this, right? And you don't want to get caught looking at information in the past like this, because that would be 3, 4, 5 years down the line, and it's not much relevant, right? If you're trying to execute today. So you want to be looking at the most immediate price action and trying to create a story around what's happening, right? And once you do that, you go to the weekly and proceed with the same thing back and forth until you're happy with what you understand. So yeah, that's the bare bone definition and explanation of a multi-time frame analysis and how to actually do it. So now that you understand the theory, there's not much else to it. So we're actually going to get started with the charts. So as you can see, this is XRP USDT. It's not something that I look at, but let's get started. So watching the monthly, we can see that the first information we have here, which is this bullish candle, is from May 2018. So not much of a relevance, to be honest, if we're looking to trade today. So there's really not much to it, right? What we can see is that we have a potential break in market structure to the upside, right? We broke the structure right here. What else do we see? We see that we at one point we had this blue candle right here. This big bullish candle was inefficiency all the way down, right from here to here. We only had buying pressure, so that's why we had those two consecutive bearish candles that filled all that inefficiency. And now we've potentially hit a block somewhere over here, right? We can see a bullish block. As you can see, two rejections, and we are now potentially moving higher, right? So yeah, that's information I can gather from the monthly. As I said, I don't need to go too much detail on what's happening because the monthly really is just to get the overall picture, nothing else. We now move into the weekly, and if we remove all this, what do we see here? Well, we see that we indeed failed all this inefficient price action, right? From here, well, let me grab this. We had all this imbalance that got filled with this wick. We've potentially hit a block at this point, right? We've got a demand zone right here. Whoops. Just like this, right? You can potentially use this area. It just really depends on how you would like to refine it. But we've potentially hit a bullish block and we moved away from it, right? We hit the block right here and we traded away. Great. What did we do next? We actually moved up, filled some imbalance, potentially hit a lower time frame block that we're going to be taking a look now, and we're starting to descend, right? So that's that in regards to the weekly. Let's now continue with the daily. So if we jump into the daily time frame, we've got even more information, right? As you can see, as you start zooming into lower time frames, you will get more information. But it's important that you start with the higher time frame so that you don't get confused on what's actually happening. And if we look at the daily, we can see pretty much the same thing, right? This is annoying. Okay. We made a high. We made a potential lower high, and we may be on our way to making a new higher high. However, that's not really the case right now, right? That's not some information I would classify as important or anything like that, right? You would look more into the more recent price action, what is actually happening and developing here. So we can see, if we zoom into the candles, we had some sort of liquidity being engineered over here, right? We see liquidity, we grabbed it with this wick, we broke structure right here, right? The moment, let me actually do this. The moment we traded below this low, we now we have broken structure to the downside, right? And what we actually did, we can see it. We made a low, we made a potential lower high, we broke structure again, right here to the downside, and a potential expectation you could have now is potentially price returning somewhere up here, hitting the block over here and continuing to drop just like this until we actually hit the higher time frame demand that is sitting here that we identified from the higher time frames, and then we could potentially get a shift into high and reaching higher prices. Or like this, we could potentially get higher prices since we actually made a new high at this point and we're respecting the origin of that high for now, at least, right? So that's some information that you can deduct on the higher time frame, such as the daily. So let me actually get rid of some of this stuff here. We don't need it anymore. It's just important that you understand that we're bearish. If we're looking at the daily, we're actually bearish because we grabbed liquidity on the way up, we broke structure down, we made a confirmed lower high, and we broke structure again, and we're potentially retracing now to make a new lower high before we continue with a new lower low. So when we look at our 12-hour, really very similar to the daily. I would actually suggest you jump into an 8-hour, for example. And if we look into the 8-hour, we can see liquidity over here. This is all liquidity. This was imbalance that just got filled with this wick, and if we look closely, we can see that we've actually hit a block over here, right? So that's something of importance that you may want to track, right? You can say now to yourself, okay, we've engineered liquidity on the downside, we've returned to an origin of a swing, we've hit the block, and now we may be on our way down, right, to descend. So that's that, maybe a 2-hour chart, and we get more information, right? We can more precisely see what's happening. As we can see, this price action is kind of messy, but I'm pretty sure people would call this a accumulation, selling climax, automatic rally, potential STs. So you could be expecting a deeper sweep, maybe ST and B, continuing down into a spring and then continuation, right? But we don't know that yet, and it's really not of importance at this point. What we can pretty much see is that we've hit this block very precisely, right? We've tapped into it and we're moving aggressively away after grabbing all this liquidity on top and potentially now targeting all this liquidity below. So now we zoom into a 30-minute time frame, and it's the same thing. Right now, if I may want to be watching out for this particular price point, because if we break structure right here this week, if we trade below this after this aggressive and liquid mitigation, again, watch the video on mitigation if you need to. It's pretty good. So I may be wanting to watch price below this area. Once we get a break below this area, right, I can then potentially wait for a retracement and return into some block inside this region. And if I see the lower time frame shifting again inside this region, right, then I can potentially take sales down, as it's very likely that we're going to be continuing dropping since we got all this liquidity over here that we need to clear at some point, right? What we've also done at this point is identified a range, right? We got the lower end of the range, which is over here, and the higher boundary of the range, which is for the moment up here. So now you know that you're trading within a range, right? And this is your range. You now can actually go ahead and try to catch pips on the way up or down, just based on your comfort level and what you're actually happy with executing on. So yeah, that's that. Zooming into the 15, as we said, we could be waiting for a potential break in market structure below this low. Once we get that, then maybe you can expect a return into the supply. As let me get rid of this because it's not looking good. Right, and let's actually do it more precisely. So we could be waiting for this low to break. If we do get that, and if we return, you can say to yourself, okay, we've got imbalance over here. We may actually want to fill that maybe into this liquidity void. And once we get there, right, I may want to be watching price here, because if we get a nice shift, I can then safely say that we can take sells down into the lower part of the range, right? Because we're playing within this range. So yeah, that was pretty much it in terms of how you deduct the higher time frame to lower time frame. As you can see, you start on the higher time frames and you work your way down and really try to understand what price is telling you, where we're potentially heading, where did we last mitigate it, where is liquidity being created, where is liquidity being grabbed, and all that sort of questions, right? So let me actually write it down. You need to ask to yourself, where did we have a mitigation? Where is liquidity being created? And where is liquidity being grabbed? Where are we structurally heading? Again, there's a typo there, but that's fine. You get the idea, right? You want to be asking yourselves those questions as you work your way down the time frames, and really try to understand what price is telling you and where we're potentially heading. So yeah, that was pretty much it in terms of higher time frame to lower time frame analysis. You work your way down until you are happy with the information that you have, and you can answer those questions that I told you at the beginning, right? Questions such as, what am I expecting next? And if we look at this particular example, what I could be expecting next is a break of this low into a retracement, right? That is something that I could be expecting. I can expect this low to break, and I can expect a retracement up here into some fills of imbalances and potentials distributions that would lead into lower prices. So yeah, that's one question you want to ask yourself. Second question could be, where are we heading, right? Where are we heading? And to answer this, you might want to be looking at the higher time frame, right? For example, a daily. And as we said, daily is absolutely bearish, right? We had this huge and actually good looking grab of liquidity that created a low, a lower high into a lower low. So we are potentially retracing. We could go ahead and push higher, but we shouldn't break above this. If we do, we're essentially not bearish anymore at this point. Or we could be seeing this as a liquidity pool into an actual supply that will then drive price lower. So yeah, that's it. That's essentially it in terms of higher time frame to lower time frame analysis. If we are discussing fake point of interest in order blocks, what you want to understand is that you want to be avoiding those that are sitting on liquidity. And this is pretty simple, but people still fall for the same trick over and over, right? If you have a market like this, let's say pushing up, now we come back down, and you see we created some sort of trendline liquidity over here, potentially double bottom liquidity, session liquidity, whatever it may be. Why are you still choosing an order block over here and expecting it to hold, right? Even though it may potentially make sense because you took some potential structure over here, you generally want to be avoiding this point of interest over here because it's sitting on liquidity. And if it's sitting on liquidity, you're probably going to have a lower one somewhere in this area that could then provide you the real shift and the real movements higher, right? So understand that, and we're going to be writing it over here. Avoid liquidity points of interest, meaning points of interest that are actually sitting on liquidity. Why would you want to trade that? You know that retail is potentially seeing this area as support or this area as resistance. So why would you bother with POIs over here when you know that if you take a buy at this point, you're following retail logic, and you're most probably going to get taken out into the real area where smart money is likely to buy into to then potentially continue higher, right? So understand that very well. It's pretty simple. Just simply avoid POIs that are sitting on liquidity, whether that be trendline liquidity, whether that is double bottom, session time liquidity. It really doesn't matter. Just avoid those POIs and have the patience to wait for those actual points of interest that are not sitting on liquidity, that do have imbalances on the way up, which signifies to you that banks actually introduced orders at those points, right? And they did it pretty fast. So that's why we have that imbalance that is going to get filled eventually, right? Because we understand that the market needs to be balanced out, meaning that we do need to have buy side and sell side liquidity being offered at both times in the market, right? So that is pretty much the first idea I wanted to discuss with you, which is avoid POIs that are sitting on liquidity, and we just went through that. So now we're going to continue with the next idea, which is also pretty important and can potentially help you out as well. So the next idea is pretty basic as well, and that is wait for discounted points of interest. Wait for those points of interest that are sitting on discounted areas, which means that now they have a higher probability of holding, because you can create a story around why price may potentially be in this case, right? As price is trading lower, you can now say to yourself, hey, price is trading lower because it's seeking that discount price area that should continue the movement up, right? And on the way down, we are creating liquidity at this point, and we're grabbing it into a points of interest, and we're filling in balances once again. So that's why this point of interest becomes a much higher probability in comparison to this one over here, right? And let me actually take a second. Let's remove all that, and we're going to be writing out the second idea over here. Wait for discount OBs. right? And we're going to be sort of doing an example over here, pretty basic, right? Let's say we have a leg up, we have a leg down, we have a leg up, we have a potential bullish structure over here occurring, right? So as a general rule of thumb, once again, you want to wait for those discounted prices over here, which means you want to be waiting for those points of interest that are as close to the origin as possible and avoiding those that are not at discount areas and can potentially be used once again to create liquidity over here. Maybe it gives you a reaction, breaks once again, people start getting into buys, right? And then we continue lower because this is not a cheap price for smart money to start getting involved into more buy positions, right? Unless you're trading a high volume time, these points of interest that are not at discounted areas will probably not hold, right? We continue, the same thing occurs, right? We trade maybe into this one. This is sort of a better price for smart money, but still may not be enough. So we may still induce over here, create liquidity, move up, make people want to start buying, potentially fail some imbalances on the way up into a point of interest over here, to then just continue lower into the real area where smart money is actually happy to add more buy positions and continue with the overall trend that, as we can see over here, is clearly up, right? So this is an area where you want to be watching price because it actually makes sense now that we could potentially be targeting this area, creating liquidity on the way out, down, filling imbalances, and being efficient. Now we can take price higher and continue making money up. So that is pretty much it. It's pretty simple. Once again, avoid POIs that are sort of sitting on liquidity and wait for those discounted areas that have order blocks in them, whatever you use as your points of interest, so that you can have a higher probability of your point of interest actually holding and providing good movements, right? So with all that being said, we're going to be quickly jumping right back into the charts and sort of taking a look at those ideas, right? Pretty quick and simple. So traders, we're back on the charts and we're going to be taking a look at what I just explained to you previously and actually translating that information into candles over here, right? So as you can see, this is GJ on a 30-minute time frame. This is current price action, and you can clearly see how simple I keep my charts, right? I don't like to complicate it. I keep it very simple and basic. So we look over here, we can see that I do have some points of interest denoted at those areas over here. Reason being is because I'm applying what I actually explained to you, right? I'm avoiding POIs that are sitting on liquidity, and I'm waiting for higher discount prices in regards to where my points of interest are going to be sitting, right? So if we look at the first rule over here, we did have some sort of, we zoom in, we can see maybe even a lower time frame. We did had some sort of point of interest over here, right? This is potentially a order block for many of you that you were potentially watching today, and you potentially took a sell position over here, and you can see how quickly you got taken out. And that is because this point of interest over here is actually sitting on liquidity. Matter of fact, this is a Asia high liquidity, so you know with probability that is going to get taken out, hence why this point of interest over here fails, right? So the next time, instead of actually executing positions at liquidity areas, even though those liquidity areas have points of interest, you still want to be avoiding that because it is probably not going to work out for you. So that is the first thing over here. Once again, pretty simple, right? If there is a point of interest that is sitting at liquidity, you want to be avoiding it. Just like over here, we could see that trendline liquidity was being built. You can see we get a reaction. Now you're potentially watching this area over here for buy positions, and you can see how quickly this fails and actually takes you out, right? So that's why you want to be avoiding points of interest at liquidity areas. So the other idea that we discussed was actually discount pricing, and we can see over here how I'm patiently waiting for those areas over here to be hit to then continue lower, because I know this is the leg that I'm playing with, and I understand that if smart money wants to continue selling, there is a probability that they want to drag it up here first to have a better area to sell, right? And better sell prices to then continue lower. But if that actually never happens, and once again, we're just sort of establishing a bias for ourselves, we never know with 100% guarantee. I also understand that we can potentially trade below this low in this area, and once we do that, this becomes my new leg, and I'm going to be waiting for the same thing, right? That sort of retracement into discounted areas over here to then continue lower, right? So understand that. Wait, really take the time and wait for those discounted areas. Now you will see how easy trading becomes, because you're no longer stressed out trying to guess which order block is going to hold, and you can see how confusing it gets, right? There's too many of them, especially once you flick through time frames, you will see how confusing it can get. So if you can create some rules for yourself and tell yourself, hey, I'm waiting for points of interest that are considered discounted areas so that I can have a higher probability of my order block actually holding. And that means that sometimes you will miss trades, but most of the times you will save yourself from executing bad positions, over trading, over risking, FOMOing into trades, because now you have a system and now you can just wait for those areas to be hit and then execute your positions without actually having to worry about the different points of interest that you can see all across your chart. So this can be considered a origin of a swing. Why? Because this started a move that actually broke this structure point right here. So this is now a valid zone for me to look for buys. We can also see that we're engineering liquidity on the way up and grabbing it on the way down, right? We can see trendline liquidity being squeezed at this point. We can see relative equal low liquidity here. And we've also got tons of imbalance, right? So we're actually fulfilling stuff while trading into our POI. Now another thing that I can notice within price is that we've been getting compression right on the way down, which means the distance between lows have been decreasing, right, as we trade into our order block, and that's usually a pretty good sign that a reversal with proper confirmation could be on the way. So yeah, that was the first slide. As you can see, I was expecting some sort of up move from this region to at least test this region, right? So let's remove that. Let's continue to the next picture because I've got everything documented. This is actually another idea. This is not of concern. So now zooming into the lower time frame, I was seeing the initial reactions, right? I was monitoring price as it was hitting my POI, and I was expecting something like this. What I actually wanted was some sort of liquidity created, then a liquidity grab that leads into a break of market structure, so I can then safely say, hey, we've not manipulated people, we're in a point of interest, and we've broken structure up. So I'm gonna be happy to take entries somewhere right here, right? So that is what I wanted to show with this picture. Let's continue. Okay, so here's actually where I took my first entry. As you can see, this is the live market, right? On the bottom right, 30 seconds for this candle to close at the time. And another important factor is that we were approaching Asia volume time, right? This was taken during the Asian session, and at that time, I know there's plenty of volume within Asian. And what I've noticed is that mitigations that occur during high volume times usually and generally provide a bigger moves and higher probability mitigations. So that this is a pretty aggressive entry, if I'm being totally honest, but this was absolutely fine within my trading plan, right? I just used low risk because I know that this this is a lower probability mitigation. However, I was fine with the risk. I saw the reward and I decided to execute on that. So let's continue. As you can see, instant reaction to the upside. We actually broke structure once again, right? If we look here, we actually broke internal structure right here, made a new high. So this was actually a great point to take another entry, right? As you can see, once we started to break up and actually move up, I decided that, hey, this order block that was left behind is actually a great opportunity to get a re-entry now that we have more confirmation, because I can agree that this first entry was pretty aggressive. That was that. I was actually waiting for price to come back here and continue going higher. All right, I had all the confluences, all my explanations in my head, and I was absolutely fine with taking another entry right there. So let's continue. And here, as you can see, this is where I was planning to target, right? Right at the edge of the external structure, right? I knew that with probability, we can actually get up here. Why? Because on the way up, all we have is trendline liquidity, right? All these POIs inside this region, I'm not too concerned because I know that this is liquidity. We've got imbalance here, and that with probability, hey, I want to fill this range up. And maybe once I get here, right, I want to get out of my position because I don't know what's going to happen at this point. So I actually sent this to my private group at the time, right, with entry point, stop loss, and take profit, everything there. So let's keep moving. So you can see price indeed came back down, gave me my second entry, and started pushing higher. If we keep going, you will see how price ends up going. And as we move into those higher volume times within the Asian session, well, price just explodes because you're on the right side of the market, and that's what happens, right? At this point, I was running at a 1 to 7, 1 to 8 on both positions. So yeah, it was just a matter of waiting for my target to hit. Let's continue. Let's see what we have. Price continued pushing up. And as you can see, I had all these lines where I wanted to monitor price. And if I saw something that I didn't like, I wouldn't hesitate to either trail my stop loss, close partials, or even close the entire position, right? But at this point, price was just moving up. It was going very well, so I wasn't too concerned. Let's continue. And this is the end result, right? At this point, we reach target. Now, if we look to the left-hand side, right, you can see that I've got all these lows labeled somehow. Now, I don't need to actually go ahead and label the phases and stuff because I already know that, right? Without the need of having to write it on the charts. So I was playing this was a 50-minute accumulation, and I was playing the 1-minute spring out of that 15-minute accumulation, right? That's what gave me the confidence to execute right here. I knew that we were accumulating on a higher time frame and that everything that was missing within that 15-minute accumulation was the spring. And I figured that if I can get an entry on the spring, I would probably have the higher RR in order to get to where I want to get. So yeah, I think this was the entire breakdown in regards to the pictures I have. And now we will go back on the charts and continue explaining further stuff. Okay, traders, we're back with the chart. This time you're looking at UJ again, but on the 4-hour time frame, right? And before I finish the video, I wanted to quickly give you some more information in regards to the POI selection, my trade management, and that kind of stuff, yeah? So as we can see here, right, that I collapsed both of my positions right at this point, and price just continued pushing out, right? If I would have held those two positions, I would be floating close to, whoops, not this, would be floating close to 150R, combining both positions, yeah? So the reason I actually closed my positions here is the following. So we can see that this is an important structure point, right? This is a confirmed lower high at this point because this broke the structure right here. And there was a very good probability we could have just hit the block and get lower prices, especially after the mitigation play we just had at this point where we created some sort of relative equal lows. So the probability of hitting the block and dropping lower was definitely there, right? Especially if I look on the 4-hour time frame, we can pretty clearly see that we have an OB sitting right here at the edge, and we could have very well hit the block and continue dropping into this block to then continue further up, right? And I didn't want to take the risk. So I decided that, hey, I'm happy with my profits at this point. I'm going to close it. And we can also see we've got plenty of liquidity at this point, right? Got some sort of support or whatever retail uses, right? So I wanted to collapse my position there. Also, I wanted to speak upon the POI selection, right? Because I feel like the POIs that look like this, where it is just a huge wick, are the best POIs and the high probability ones, right? Especially if this POI previously mitigated another important landmark, right? As you can see, this wick right here pretty much mitigated close to the 50% of the of this origin swing. So yeah, this POI is actually pretty powerful, and it becomes valid once we get this internal break. We get internal break, we hold bearish order flow here for a second, we take out liquidity, we accumulate, and we move up. Pretty self-explanatory and easy to understand, right? Now, I will start by listing the 4 core principles that you will need to follow to make the strategy work. And the 4 principles are the following. The first one is structure. The second one is liquidity. The third one is your POI selection. And the fourth one is your confirmation / trigger. Okay, so these are the 4 principles, and I will go into in-depth explanation of each and every single one of them so that there is no gaps or confusion, right? So let's actually get started with structure, which is pretty important. So for that, let's draw a potential bullish market. We can all agree this is a market that is pushing up. And let's imagine this structure right here is your, for example, 4H time frame. This is your 4-hour time frame. And the rule within structure that you need to follow is the following. You need, and this is crucial, guys, to wait for the higher time frame and lower time frame to match. Now, what do I mean by that? So as we said, this is our 4-hour time frame. And if you zoom into a lower time frame, potentially a 15-minute, 5-minute time frame, what you will find is that within this 4-hour bullish market structure, yes, the lower time frame will be doing something like this, right? Well, you will find that price is pushing up. However, you have quick breaks that then resume the bullish trend, and you may be wondering, well, I sold here and I lost, and that's because your high time frame was bullish and you just went ahead and sold because the lower time frame quickly switched bearish for a second, right? So the lower time frame will be pushing up and then it will completely switch, right? Maybe continue bullish for a second, but then continue switch because now the higher time frame is retracing, and until the 4-hour retracement is done, the lower time frame will not shift. So your job within structure is to actually catch the end of those retracements and ride the impulsive continuations back up, right? Your job will be to execute on this area, this area, this area, and essentially at the end of the 4-hour retracements. So you will then wait for the 15-minute and lower time frame to shift bullish, and that's where you are going to execute to potentially retest the highs which is going to be a very high probability setup, or depending on how you manage, you can actually say, okay, we made a high, we potentially have a higher low here. I'm confident in holding to a potential new higher high. So yeah, that's in regards to structure, and do not worry, I will be giving charts examples in a second, but I hope that was clear and you can understand it. Your job within this strategy is to try and catch the the ending of the retracement within the higher time frame so that you can resume with the higher time frame expansions. Now, I don't want you to stress about the idea of trying to catch the very bottom of the retracement, right? Because there's plenty of opportunity to make your money within the expansion, right? You don't need to worry or stress about the idea of catching the very bottom. This was just to illustrate the principle that you need to keep in mind when looking at structure, yes? So let's actually continue drawing the structure, right? So the lower time frame hits the higher time frame end of the retracement, then that means that the lower time frame would then continue and shift bullish, right? That's where you look for your entries. You can potentially get an entry here and continue up. Now that doesn't mean that price cannot break short-term structure, right, and flip bearish to then just continue up, right? And the same thing will be happening over here. We make a new high, so the higher time frame needs to retrace, and that means that the lower time frame is going to flip back bearish until the retracement is done, and it will continue back bullish. Now, you don't always have to expect that price will retrace the entire move up, right? For example, if you have a structure like this, that doesn't mean that price is going to come back here and then resume, right? There's multiple options here. It can retrace 50% and continue. It can retrace deeper without coming to the edge and continue. So you need to be aware of that, okay? You're not always going to get the perfect retracement towards the edge of the structure, right? So now that you understand that, let's actually look at the charts and try to implement the ideas I've just told you. So we're looking at GU on a 4-hour time frame, and let me see. Okay, so as you can see here, we've got a low, we've got a high. This actually breaks structure because we clear all this. This becomes your new high, and then as you can see, price slowly retraces, right? Shifts bearish during the retracement, as I've been telling you all the time. That means that the 15-minute, potentially the 5-minute, is going to be extremely bearish at the time, and then you hit the end of the retracement, which in this case does come to the origin of the swing and continues higher. So that was everything in regards to structure, and let's now continue with the second rule, which is going to be your POI selection. So let's go back to the drawing board and continue with the remaining of the rules. So let me clear all this. And I know I said before that the second rule was liquidity, but we're going to do liquidity and POI at the same time because I think that will provide you a much better understanding of the concepts and the ideas behind the strategy. So POI stands for point of interest. And liquidity, I just previously made a video on liquidity, so if you do not understand that, you can always go back there and watch the video. But let me give you the rule within liquidity for this specific strategy. The rule is the following, which this is too big. You need liquidity to be grabbed into POI, right? You need some sort of liquidity. Any liquidity type is valid. As I said, there's two different types of liquidity. There's hidden and visible. You can go back to that video for that information, but any type of liquidity is valid, right, for this rule to be fulfilled. So anytime you have liquidity into your POI, your liquidity rule is fulfilled. Now, in regards to POI, you need at least a 61% retracement of the impulse for a POI, okay? And do not worry, I will illustrate that in a second. So 61% plus retracement is necessary to consider a POI. And let's actually go back to the charts because it's going to be much better to explain that. Whoops. So let's continue with GU and let's try to find what I mean, right? So this is a okay example. As you can see, just ignore all these previous stuff. We're just going to be focusing on this, right? So you have a low, you have a high that breaks structure right here. So this is an impulse, right? This is your bullish structure and you're waiting for the retracement. Now, the POIs you can use within this impulsive leg, as I said, must be below the 61% retracement. So for that, you can always grab your FIB. You can draw it from the bottom to the top. And any POI, right? So price, when price is below this area, from here to here is where you can frame your POIs, right? Anywhere above it, you're not looking for buys. Why? Because the probability of price continuing in deeper retracements is there and you don't want to get caught into that, right? So that's pretty much it for POIs, right? You need price to retrace at least 61% for your POI. Now, you will probably have the scenario you have multiple POIs. As you can see, we have one here and one here. So what you would do is actually draw all your potential POIs below the 61% retracement. That's pretty important. And then you're going to wait, right? So that's in regards to POI. Wait for price to retrace at least 61%. And that's how you're going to get the high probability ones. So that's that in regards to POI. And in regards to liquidity, I think it's also pretty clear. This will be a valid example of liquidity or inefficiency being grabbed into your POI. As you can see, we've got some sort of trendline liquidity here. So your liquidity aspect is fulfilled, right? You can put a check on that. Liquidity has been grabbed into my potential POIs. My POI is also valid because it's below the 61% retracement. So you can do that as well. And my structure point is also valid because we just made a new high. So in this case, all the three rules would be fulfilled for you to actually look for entries within this region. Now, the only thing that would be missing now is your confirmation trigger. And for that, let's actually go back to the drawing board. Let's remove this and let's talk about your confirmation. Now, your confirmation / trigger will happen inside your POI, okay? The only scenario where you can look for confirmations is within your POI. If price is not within your POI region, right? If price has not done the 61% retracement, just like in this case where price barely retraced and continue high, then you miss the trade and you need to accept it and you are not going to FOMO into a trade here, there, and there, right? Because that's only gonna get you hurt. So it's pretty important that you wait for your confirmations only inside your point of interest, which means once price reaches your point of interest, then you can look lower time frames to potentially catch your confirmation. And the confirmation I'm going to show you now is pretty powerful, works very well if you have structure right, liquidity grabs, if the impulse move has been retraced more than 61%, then your confirmation is going to be powerful. So let me actually give you an example of a confirmation, right? So let's imagine you have, let me get this back. You have a bullish structure like this, and you're waiting for your POI right below the 61%, right? Any POI inside the region would be valid, and price, whoops, let me delete this, price comes back down. And for your confirmation rule, what you will need to do is look and zoom into lower time frames to see the price action developing inside your POI, okay? So one of the confirmation rule I will give you here is the following. You will need some sort of liquidity creation in form, for example, of consolidation a grab, liquidity grab, and a break of market structure. That's going to be your best confirmation. And trust me, guys, I've been doing this for a very long time, and this is what exactly works. You need to wait for the market to engineer liquidity while it's in your POI. You need to wait for price to grab the liquidity within your POI region, and then you need to wait for price to break structure, right? So let's actually write it down. Confirmation is liquidity engineered within your POI or right above or below it, right? If the market was to engineer, let's say this is your POI, if price was to engineer liquidity just above it without touching it and then grabbing it and then you get the break, that would be also valid. Yes? So liquidity engineered within your POI or very close to it, and a break of market structure. That's going to be one of the best confirmations I can give you here on YouTube for free. You're going to wait for price to reach your POI with all the rules I gave you before. You're going to wait for the market to engineer liquidity, which could be in form of consolidation and in the form of potential equal lows, right? That then get grabbed, and then the break. And then, yeah, that's pretty much it. You need to wait for your confirmation, which is the grab of liquidity within your POI and the break of market structure. So now that you understand the 4 different principles of the strategy, let's go back to the charts and let me give you a quick breakdown of how it would look when you put everything together. And for that, I'm going to walk you through one of the trades that I took last week, just following the 4 principles, right? It was on EU. So we're now looking at Euro USD. And if we look at structure, right, your rule number 1 is your structure, lower time frame, and high time frame structure need to match. So let's go ahead and confirm that idea. So as we can see, we've got a lower high here, lower low, lower high, and we just made a new lower low, and we're retracing. So structurally we're bearish, but currently we're retracing, so we're bullish, right? So we need to wait, and we're going to wait for our POIs to be hit. And as I said before, any POI inside the 60.18 retracement is valid. So you would go ahead and grab your FIB tool, place it at the top, drag it to the bottom, and wait for price to reach any POI inside the 60.61% retracement. So let me go to a slightly lower time frame, maybe a 30-minute, maybe even the 15-minute. So now we understand that, hey, any POI above the 61% retracement is valid for me to look for sales, because structurally we just made a new low and all we're doing is retracing to create that new lower high to potentially continue lower, right? So let's play price. And as you can see, I had this POI marked at the time because this is a POI that is above the 61% retracement. So that's a valid POI. So continue. Let's see what happens here. And as you can see, price comes to our POI. This is the moment where you would look into the lower time frames for your confirmation rule, right? But as we can see, we've grabbed liquidity on the way up, created the low, and now we're retracing. So your structure rule is met, your liquidity rule is met, your POI rule is met because we are above the 61%. And now all is missing for you to execute your position would be that confirmation trigger. So let's see how price develops inside this price action. So, okay, we're watching price. Price hits the POI. And let's continue watching. Price plays within our POI. We're not executing yet. And as you can see, price comes back up. There we go. we can see here that we just created liquidity, right, in form of this consolidation. We just spiked above the high, as you can see. We should be spiking above the high. There we go. We spike above it. With this wick right here, we clear all this liquidity, which means that now the liquidity factor of your confirmation is valid, and all you need to do is wait for that break in market structure. Now, it could get confusing because you may ask yourself, well, why do I use this or this as a break in market structure? And the answer is this, because this is the true origin of the swing. So you would wait for this low to be breached. And once you get that low breach, we can continue. So you don't have to execute here, you just need to wait. So let me speed this up. Price breaks below it. Now we're valid to look for sells. Why? Because structurally we're bearish. We're at the end of the retracement potentially, because this is the lower high, and if they want to continue making money selling, they won't break above this high. And the lower time frame has officially shifted. We have a shift in the lower time frame market structure. So all you need to do is wait for the origin over here. I would wait for a POI somewhere in here, and I would place a sell limit with your stop loss just above the highs. And you can target way lower because you know we're bearish and we should be making new lows, right? So let's see what happens here. Price continues, plays around, essentially is creating more liquidity with these movements up and down. And as you can see, whoops, price comes back up, taps you in, right? All your rules are valid, so you can take this trade, and let's see what happens. Price plays around for a bit. Let me copy this just so we don't lose this and drag it over because it's getting too big. Just like that. And price continues to melt. And all you did in order to catch this trade was follow the 4 simple rules I just gave you, right? We had bearish structure, we have liquidity being grabbed into your POI, we have a valid POI because it's above the 60.18%, and we got the confirmation inside our POI. So yeah, that's that. So I'm actually curious to see what happens here. So let's wait for that. As you can see, price is taking its time, so maybe zoom into slightly lower time frame, a higher time frame, sorry, and as you can see, price just continues to melt. And that's how you can have a profitable system. I can guarantee you, if you follow this system, you will make money within the markets. So remember, structure needs to match, liquidity needs to be grabbed, your POI needs to be valid, and you need to have your confirmation.